Good morning and Jai Shri Krishna to one and all. I, Tezna Sampat, on behalf of Team Drshtikon, would like to welcome you all at the 11th webinar of Drshtikon Talks. As you all are well aware, at Drshtikon, we have leading personalities who come and share their views and ideas with us. We would like you all to get maximum value addition from these talks, and hence, I would request to keep your mics on mute and turn off your videos so that there is no distraction while the speaker is talking. Any questions you may have can be typed into the chat box and they will be answered towards the end of the webinar. In case there are any queries left unanswered, we assure you that we shall respond to those by emailing after the webinar. If you have any further feedbacks or suggestions, you can convey them to us by email at drshtikon.talks@gmail.com. Our speaker for the day is Mr. Khatau, Mr. Anand Khatau at the Julius Baer. So, I request Hina Bhimani to introduce our speaker. Over to you, Hina.
A very good morning to one and all. Jai Shri Krishna. As said by Robert Kiyosaki of Rich Dad Poor Dad fame, it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. To help us decode the language of finance and investments, we have with us today Mr. Anand Khatau. In today's session, Anand Bhai will be sharing his treasured knowledge with us about investment opportunities. He currently holds the position of the Managing Director and Senior Advisor of Investment Advisory Division, Julius Baer Wealth Advisors Private Limited. Julius Baer is a leading Swiss private banking group with a focus on servicing and advising sophisticated private clients and a premium brand in global wealth management. The group has the largest international presence in all of Swiss private banks with more than 50 locations in over 25 countries. Julius Baer acquired Merrill Lynch's international wealth management business in India in September 2015. Anand Bhai has been a part of the team that established Merrill Lynch's wealth management practice in India. He has extensive experience in acquiring and managing client portfolios. He works closely with leading fund managers, analysts, and leading industry players to assess the global situation and formulate the strategy for asset allocation in client portfolios. Prior to joining the firm, Anand Bhai was a senior consultant with EY, Ernst& Young, where he was advising Indian companies as well as MNCs on their India strategy, in addition to advising clients on their tax and business matters. Anand Bhai is a commerce graduate from the University of Mumbai and a chartered accountant. He is also an avid marathon runner. We look forward to a great amount of learning through this session, Anand Bhai. Over to you.
Uh, Thank you very much for the generous introduction, Jai Shri Krishna. And at the beginning, it's really overwhelming to come to this forum and address everyone. Although investing by itself, I'm sure all of the everyone who's watching has made more money and knows more about investing. But we'll try and run through what our experience has been in the last 22 years, and we'll just start with a short presentation. We'll try and address different topics, part by part, and subsequently we'll open it to question and answer, so to make it more interactive. And Abhishek, you can start the presentation. Thank you. Yeah. So overall, we'll break the discussion into 5, 6 parts. Overall, what is our holistic approach to investing? How we build a portfolio, when to invest, what happens after you market outlook, which would be of interest to everyone. What is the current market situation, and where we can invest, and what are the current investment themes, ideas, and opportunities that lie ahead. So yeah, we'll start the next slide. So when we invest, what we try and do is first and foremost see what our overall situation is. Normally, what happens, for example, what is your goal, what is your family's goal, what is your aspiration, what are we working towards, what we do. For example, at one point of time, one of our clients was going on expanding his business. At some point, then I asked him, what are you doing for? Are your children interested in this? Are you really who's going to take it forward? At that point, he suddenly realized, yeah, that it was pointless, going on expanding, taking on loans, taking on future liability. So those are the questions we really ask everyone at the beginning, because a good foundation, a good structure is what helps everything to put in place. Otherwise, we make decisions based on our health and age today, but without looking at who's going to take it forward, what is our situation going to be 5 years, 10 years down the line. So different investments overall, I mean, it's best to take an overall approach from the beginning, because in our what we have seen in an entrepreneur's bid to succeed, one keeps expanding businesses without taking an overall approach. So there are things which we deal with, like with how much one should invest in real estate, how much wealth should be in illiquid products, how at what point one needs to retire. So those kind of things. Abhishek, next slide. Yeah. So as I was saying, the most important part at the beginning is what purpose are we investing for? What do we want to do with the money? Some people invest to make money for charity in the future. Some invest to make sure that it's left for their heirs. So different people have different aspirations, and depending on what our wants are, we advise people on building portfolios from being, some people are risk averse, so we make portfolios which are overweight in debt. Some people are aggressive investors, so most of the investments then would go into assets which are appreciate in capital and low on debt. So depending on each person's personality, because finally, like Hinaben said, the investment should work for us and we shouldn't be for our investments. So we have to ensure that we finally get peace of mind from them, security, and we are able to live our lives better and make people's lives around us better. So that's what we really want everyone to run their investments in a way that it improves everybody's lives, our own lives, and lives around around us and the society's lives. Yeah, the next slide. So this is a slide which shows us, the risk curve. What is the risk you take, and what are the products available from the, when we start. The safest things are bank deposits, liquid funds, short-term debts, which have very low risk and give a kind of certain return. And it goes all the way up to private equity funds or real estate funds, which are kind of illiquid but have a potential to give the highest return. Of course, recent experience also shows that bank deposits also at times can go bad. So we had some of the banks going down, and the returns in debt have gone down so much that people tend to not buy debt. So globally, almost one third or 40% of debt is yielding zero return. And in some cases like Switzerland, etc., actually when you keep money in debt, it gets you negative return. You are charged a fee for keeping money in debt. So globally, it's become a challenging situation for investors whether to take risk or not to take risk. If you don't take risk, you are earning almost negative or zero returns globally. So in India, of course, it's not so bad, but still our rates of interest have gone down significantly, and post-tax returns can be very low. Yeah. So next slide. Yeah. So the way we approach this is, although debt gives low returns, what we tell people, if one has, the way to take it is, there are two ways to put amount in debt. Either you say 100 minus your age. So if you are say 20 years old, so 100 minus 20, so 80% would go into equity, or vice versa. So if you are 80 years old, 100 minus 80, 20% would. So that's a very basic thumb rule. But other way, the way I look at it, if one has a very large portfolio and you don't really depend on debt, then the way I put it is that you put as much as you need for the next 2-3 years. you put the you multiply the number by the percentage interest you're going to get. So if you're, for example, if you need 100 rupees, you put say 1,000 rupees or 1,200 rupees in a fixed deposit, which would take care of all your yearly expenditure, and then rest you can, after allocating different expenses, the rest you can start investing. So that's another way to do it. But it really depends on each one. So there are some investors who get very worried if the market falls by 10%. So those type of investors should not try and take too much risk, because fluctuations have become very, very high in the markets today. For example, in March, in the recent history, if you go back in March, everything was down by almost 40-50%. The market crashed from, say, 12,500. It went straight down below 8,000 in a very short period of time. So those kind of fluctuations have become the norm, and they happen quite rapidly. And each time, almost every year, we have seen 10-20% fluctuation in the index happens without any warning or without any, it's very quick. So very difficult to time the markets. Next bucket we have shown is the capital appreciation bucket, where some amount of risk is there, but not very high risk. So there we recommend everybody invest for at least 3 years, and there we try and do whatever is liquid, as in liquid in terms of it can be sold in the market if funds are required. So that is the second bucket. Again, that also requires you to hold for 2 to 3 years at least, so that the volatility, you don't make losses due to volatility. And the last part is the aspiration bucket, which can multiply, but one should be prepared to see lot of fall or fluctuation in its lifetime. So that money would be small, but can kind of would be, say, small cap stocks or real estate, etc. Those, or venture capital, all those would go in the aspiration bucket. Next slide. So these are some of the principles of portfolio appreciation and what kind of returns are expected. These are just samples. So like I said, conservative portfolios, most of the money should be in debts, up to 70% also should be in debt. And the returns they would generate. So depending on what kind of profile you are, and it's very interesting, everyone, normally feels they are of a certain profile, but we have an internal test or a, kind of question paper questionnaire, which when one answers that, the kind of profile you yourself thought, you end up being something different, because when the risk emerges, people tend to have different outlook towards the way they react towards the market fluctuation. So we generally we get to know investors in market cycles and how they truly react to fluctuations, because people are averse to large fluctuations in their portfolios. Yeah, next slide. So these are various products that are available. In fixed income, of course, we have bank deposits, provident fund, mutual funds have liquid debt funds. Recently, tax-free bonds have become very, very popular because tax rates have gone up, and tax-free bonds ensure that you get a liquid cash flow, and taxation on mutual funds, etc., the long-term period, etc., has also gone up. So this has ensured that tax-free bonds became very popular. And of course, government stopped issuing new ones. So there was a huge premium on the old one. And there is a shortage in the current market. So the tax-free bonds have become suddenly very, very popular. And of course, preference shares, but preference shares have lost their, everyone used to like them because of the tax-free nature of the income. But now the dividends being taxable, it has kind of lost its significance, or people are averse to investing there. In equity, we have shares where you can buy shares directly from the market, and it's become quite easy now with the demat accounts and everything traded electronically. You have mutual funds which actually give you a huge basket of products, and they come in almost every thing that you believe you want to invest. Everything is represented through funds. You have exchange traded funds, you have portfolio management schemes, you have ULIPs which give you insurance along with the equity exposure. And recently, the most popular thing is international equity, because the last 3 to 5 years, the tech shares in the US have given the highest returns. So that has become the most popular form of investing today. And of course, the other thing that helped was rupee depreciated. So generally that has gained lot of people like to invest in international equity now. And the LRS scheme also is used, and you can use it, do it through funds from locally also in this. The next option is, of course, alternative and other schemes. So you have gold ETFs, you have gold bonds, which have become very popular because gold suddenly kind of went up. So then you have real estate funds, you have real estate debentures, REITs. REITs are basically real estate, rental yields divided into, put into mutual fund formats. There are InvITs, again, similar situation on infrastructure projects. The yields which come out have been, you can invest through in a financial format, which gives you interest. Then you have private equity funds, hedge funds, and recently a lot of structured products also have come, where you get market linked debentures, which are there is a tax arbitrage, so that has become very, very popular. And of course, lastly, you have commodity funds. Yeah, Abhishek, next slide. So now the most, everyone normally has this question: when do you invest? And this has become more and more significant because there's a lot of volatility in the market. So if you were to be, if someone told you today the index is near 12,000, but someone told you that what happens if I give you the index at 8,000, you would normally say no, I'll jump at it and buy everything. But that's not the case. When it really happens in March, for example, everyone was selling and not buying because everyone was worried that because of the pandemic things are going to shut down. But what happened was that the reverse happened. From there the market has kind of bounced back by almost 50%. So normally everyone says you should be a long term investor and keep investing, but that what has happened in the last 3 5 years, the index has not really given too much return. So people are right now dissuaded from investing over longer periods. The returns have not been so high. So what we suggest to everyone is to invest regularly and do it in small parts so that you don't get caught on the upside or on the downside due to fluctuations. So what we kind of recommend to everyone is that you invest regularly and at regular intervals without taking a view, and hope that in the long term markets will do well, because that's been the trend. If you see from the 80s where the index started at 100, today it's around 40,000. So over time, markets tend to go up. So that's the reason why we tell everyone to invest regularly and do it in small parts. Next slide. Yeah, so more important what we see, because we deal with a lot of promoters, entrepreneurs, people who have already become rich, we tend to tell them to preserve wealth, because that is the most important thing. And it just makes sure that you don't lose everything that you made with a lot of hard work. So we keep telling people to review asset allocations from time to time, to be disciplined. So in our experience, what is most important in investment or making money is, first is discipline, second is patience, and third you need some amount of luck. So if you do the things rightly, the way there is some amount of science, there is some amount of math, and then finally you have to wait for things to happen, because they take things in the market are kind of unpredictable. And I will run you through in the next few slides what has happened and why things are behaving the way they are behaving right now. So in order to not lose too much wealth, we keep telling everyone to keep checking. If things have really appreciated, you keep booking profits, you keep reducing your risk. Like 2008, everyone was overweight in real estate, and suddenly from there it has not given returns for many, many years. So now people are unwinding, and now the prices have started correcting finally. The other thing what everyone does is, we go to parties, we go to we meet people, and everyone talks of what is the most in thing. So like recently, what is in is the tech shares of the US, and our tech shares also have recently gone up. But that's the most sought after thing. Few months back it was gold. Everyone wanted to invest in gold, either through ETF or either through or the government scheme which had come up. So that's what happens. You always tend to invest in the most, in what has given you the most return. And unfortunately, what happens when everybody is buying, and from then on, the either the stock or the investment which you have made starts coming off. Yeah, Abhishek, next slide. Yeah, this is what we suggest everyone looks after, as in similar to what our businesses are. We tend to not, look at these small things like how we are holding the investments. Either we have made nominations, these small simple things, just housekeeping, but it's very important because it ensures that once something happens to us, the next generation is easily able to access the wealth which we have created, and it's not scattered everywhere. Otherwise what happens is it's very time consuming now to now it always was, to make sure that everything goes to the right, in through the right hands and to the right people whom we thought. So we always ask everyone to be more organized with the financial data, where our policies are, what have we insured, what is our plan for succession, have we created a will. Simple things like writing wills to update them, to make sure they are given in the right hands, they are there easily accessible to the person who's going to execute your will. So all those things ensure that there is no acrimony post us, to ensure that the person whom you have wished for, you have worked all your life, gets it in the right format, without getting relations spoiled internally in the family. So it's very important to make sure that these small things are looked after. And now especially everybody lives very busy lives. So in our travel, in our need urge to expand, we tend to forget about these small things, and they are actually the most important things that we should look after. And always the best time to start is now, because we always believe that we are there forever and nothing will happen, and we'll get a signal when we are kind of not going to be there, and then we start planning. So people always inevitably delay it, because there's no hard and fast rule like you have to file a tax return by so and so date. This doesn't have a date, so you tend to just delay it. And it also requires some difficult decisions, whom you want to give what, etc. So you, because you don't want to take those decisions, you always procrastinate them or leave it for tomorrow. And that's what we have seen leads to a lot of difficulty subsequently. Yeah, next slide. So these are the things that, again, it's a roundup of what all we do. It's a quick summary of what all we should look at: how we plan our finances, how we structure wealth, what is our succession plan, how, when we retire, taxation. So this is a repeat of the slide. So, but if you are going to relocate nowadays, a lot of clients have children who have gone abroad. The tax laws there are different. They have they have taxes on inheritance, etc. So those things have to be looked after. And lastly, philanthropy, because it has become a very popular thing. Everybody wants to do charity, and in the US, for example, people have given most of their wealth away. So that trend is picking up, and it's a good trend. People are really thinking about how to make philanthropy also more institutionalized and more structured. So that trend is coming into India. Next slide. So so these are some of the trends we have seen when people, behavioral finance trends which are important in the market. So the first trend is anchoring. For example, recently, if we are following stocks, say Bajaj Finance had got to 5,000 in prior to March. So now, if someone is holding a very large quantity of it, and if you ask him to sell, right now it's trading at 3,500, the person will not sell unless it comes back to 5,000. So sometimes you never end up getting that price, and the stock may, I'm just giving a name, but it's not, I mean, just to make it, make my point clear, I'm not referring to any stock per se, but you end up not selling a stock because you keep waiting for that price which was there at one point day to come back. So one should not do that, especially, if one has a very large exposure to a certain stock. If things have changed, we should take notice of that and not feel that that was the right price. If I didn't sell then, I should not sell now. Then overreaction and recency bias. So for example, recency bias is, till recently bank stocks were doing well till March. So people ended up just buying the same shares, and suddenly after a correction, we are seeing that the bank shares didn't go up, except of course the leading banks. Other shares have not gone up. The non-bank finance companies which were there, they have not gone up, except the leading ones. The others have just kind of fallen off. So that tends to decide, make you decide what is good. For example, right now FMCG shares did very well, so people just go on buying the same shares because those have done well. So that trend definitely has done well. The recent trend was that quality, people buy at any price. If the more expensive it is, the more it is sought after. So people keep buying high PE shares, and that's been the trend, that risk kind of gets forgotten in that. Then mental accounting is also what people do, is that they will break up their portfolio. Say they'll say this is for trading, this is for long term, this is for short term, but actually all of your money is yours. So whichever basket you put it in from your mind, finally it's your whole portfolio, which you should take a holistic and a long term approach on. So that is again, confirmation and hindsight bias is the same thing, that you tend to look at what had happened in the past, and you feel if the market corrected from 12,000, it's going to correct again, so you keep say selling the nifty at 12,000 thinking it's going to fall. But history doesn't always repeat, and it's kind of dangerous to go on that. So a lot of people trade on the prices that were there, and they keep looking at 52-week high and 52-week low, or what the trend is. So that can be very risky. Then the next trend is gambler's fallacy, which means if you lose money, you try to make it back, so you put more money to it. And if you make money quickly, then you feel that you are invincible, and you go on increasing the investments that you make in the market. So that is another one, is a herd behavior, where if everybody is buying gold, it has to be right, and that is what is going to go up. So that is another one. And last but not least, of course, overconfidence, where you become very sure if you're doing something right, you go on increasing your bets because you feel, no, that's the right thing and I know everything. So market each time kind of teaches you that you didn't know everything, and something different happens. Like no one thought that this COVID would affect everything so much. In fact, it started from Jan, but finally it took effect in March. So it took so many months for it to take effect. So one doesn't know how and at what time things impact the market. Next slide. Yeah, this is the second part of a presentation, and it is related to what is happening currently in the market. So the general view, if you ask anyone, any of our clients, that they are shocked that why is the market going up and everything is down when the lockdown has kind of killed the economy. Why? Just taking a view on things around, everyone started reducing exposure, but still the markets have gone up because central banks across the globe have started printing money, and they have started cutting interest rates artificially. So much so that every time there's problem in the market, there is a talk of stimulus. So even recently, now US is considering one more round of stimulus. So it's like heads you win, tails you lose. So if the market things are going bad, you print more money, so markets will go up. So things are good, market has to go up because things are good. So either ways, people are led into a belief that markets are going to keep going up, and it's very tough for a investor, because if you invest in debt, you are not getting any money, and if you invest in equity, it there is a belief that it will keep going up because governments across the globe will support the market. So that is what has happened. What we believe, or what is one of the things I said is global liquidity. Globally, markets have rallied, and there is a view that the dollar will weaken, which will lead to a lot of flows into emerging markets. So which is what we are seeing right now, that the dollar has started to weaken against a basket of currencies. So we are seeing a lot of money. So across board, if you see in India, of course, Reliance raised a large amount of money. Then you had Kotak Bank raised money, ICICI Bank raised money, HDFC has raised money. So you can see Yes Bank was able to raise almost $2 billion. So deals are happening everywhere. Today I was reading in the morning, Jet Airways also has got sold. There are bids for DHFL. So other than PSU shares, almost every other segment has been able to get transactions. Lot of companies which went bankrupt have been able to sell off. So we are seeing liquidity flow into almost everything. So markets have done well primarily because of that, because easy money and funds being available, generally easily available to almost anyone who requires it, private, be it private equity. So yesterday again, Blackstone is buying the real estate portfolio of Prestige, which is another $2 billion. So that way even India has seen a large amount of liquidity flowing into the country. Next slide. Yeah, so although the markets have gone up, people are not feeling as if they've made money. So the reasons we have just kind of pointed out, large amount of the Nifty going up was due to these four shares, basically Reliance, Infosys, TCS. So they almost 40% of the rally was because of these three shares. They kind of doubled from the lows, and this has got more recently. Of course, you must have seen Infosys, TCS, etc. The tech shares have rallied further and taken the market from the point where we had done this analysis at 11,300 to almost 12,000 now. So market is very, very narrow. And the shares which did well in March, for example, Hindustan Lever, Bharti Airtel, Nestle, all those are down from those level. For example, Nestle was at 18,000. Today it's gone below 16,000. Or Levers was at 2,600. It has gone below 2,100. So it's quite, the market, there is a huge amount of fluctuation. So stocks like Coal India, which are almost giving 10 to 15% of dividend yields, are trading, way lower than what they were earlier. So market breadth or it is not as widespread, and so people are feeling kind of left out, that those who are invested are also unhappy, and those who are not invested also are unhappy, thinking they missed the bus. Yeah, so next slide. So where do we see, or what should one do from here? So equity markets, in our view, should do better because the data seems to be coming back. And if you go around from at least India perspective, when you go to the market or you go outside, people are coming out. Is it due to COVID fatigue or no one doesn't know? And the data suggests that the fatality is not so high. Of course, I'm not an expert. I'm just inferring. So the view is that we may not the immunity which Indians have maybe slightly more. We are hoping that it's more, and things start coming back to life, and people will start going about their way, or the vaccine comes out soon. So the way things are, that it may, hopefully we don't go for a second shutdown. So in that sense, the GST numbers, auto sales, electricity, power, utility, all those numbers are looking up. And maybe discretionary spending may go down a bit, but two of the large things that India does, say software, the sector is doing very, very well. And the sector is doing quite well. And so IT leads to a lot of rub off effect. So people take loans, people buy vehicles, all the IT workforce creates demand in real estate, so that one segment is doing well. Second, our pharma sector is also doing well. So that is another part. And third, of course, the government policies. The previous slide, the next slide, Abhishek. So post this, the conflict that we had. Okay, this slide basically talks about the stress that is there on the government system because of taxation revenues dropping very fast, and huge amount of fiscal deficit taken for the package which they keep announcing from time to time, because of distress being there in different situations. So the government is under that pressure to announce more fiscal liquidity, because from point to point, for recently the Supreme Court is asking the government not to charge interest on the moratorium. So those kind of expenses may keep coming up, and they have to be funded by the government, because if the government asks the banks not to charge, then the depositors will say, that the banks will say, why should we pay the depositors? So all those situations can keep cropping up. One doesn't know how it will fall out, but our view is things will straighten out. And hopefully things will improve from here. So one more, like this point I spoke about, Indian private banks are well capitalized. Yesterday we had HDFC Bank results, which were also quite good, and the NPAs are not going through the roof as what was estimated earlier. So even State Bank has said that the moratorium has not been used as heavily as they thought, and it's come down quite sharply. So hopefully we feel that a mix of the bank's ability to raise money for a lot of transactions like Jet Airways, DHFL, etc., which were stuck going through. And people, of course, Indians have a habit to bounce back. They don't depend on government support as much as globally people do. So things, in our view, should improve from here. Yeah, next point. So the market valuations are quite reasonable. If you remove couple of sectors from the index, then there is a huge amount of value in the other part of the market which has not done well. So utilities, then you have manufacturing companies, you have infrastructure, capital goods, cement, all those sectors have just underperformed. These are the stocks which we call the economy sector, which has not done well. So because people have lot of, the liquidity is high, people wanted to play defensive, so everyone kept buying defensive stocks. And so the defensive stocks like Levers, Hindustan Levers, Nestle, Asian Paints, all have done extremely well in the last few years. But they have become very expensive. This is a chart which shows what has done well, what is the current valuation. So as you can see, autos are trading at a huge premium. Oil and gases, of course, is because of Reliance. So that is trading at a premium to the 10-year averages. Then technology shares also again have gone up. Consumer stocks are trading at a huge premium. Then you have the healthcare. Okay. So as you come down, the cement, infrastructure, capital goods, all those are trading way, way below their averages. The next data point is on domestic mutual fund flow. So that has turned negative because investors have kind of got dissuaded that money has not been made and people have started redeeming. That is another sign that the what I was talking about, herd mentality, where people are en masse removing money from there because the past returns have not been strong. So people are kind of investing directly into stocks which are going up or buying ETFs. Next slide. Abhishek, next slide. Yeah. So as I was saying, the outlook looks positive from here. There are a lot of sectors which are undervalued, and the economy by itself should do better because after the border conflict which we had in China, government has become more aware of the need to support industry. They've started doing quite a few reforms, like we've seen agriculture reforms, we've seen taxes on manufacturing companies go down, we've seen lot of import duties also go up, customs duty, import duty. We've seen reforms in the labor sector also, which they've brought in, which was a demand from the industry for quite a while, that we should have some kind of policies on labor, etc. So a lot of states also have brought that in, and so has the government. So all those put together, I think they are quite serious this time to reduce the imports and make sure that our manufacturing capacity, which was is built up. So our GDP, manufacturing as a part of GDP is only 16%. The government is targeting to take it to around 25%. So hopefully this time around it should work out, and we feel that those measures are already taking shape. So this is another interesting slide which shows where every time there is a crisis, the market leadership changes. So in 1991, India faced a balance of payment crisis. Post all the reforms that we took place, the market went up 3 times in 4 years after that. Then we had 2001, we had an IT bubble. After that crash from 2003 to 2008, we saw huge boom in infra stocks. They went up 7 times in 4 years. Then in 2008, we had the banking crisis. Post that, all the infra stocks collapsed. And then you had FMCG sector and the defensive sectors going up, pharma, FMCG, etc. And they gave huge returns, which have continued till very recent times. We got huge returns from that segment. So 2020, there is a huge, this crisis which happened. We feel that which are the sectors which will do well. So the next slide again shows what happens after large returns are made in a particular sector. The next few years, the returns kind of lag. So 92, we saw the whole market compounding for the 3-4 years at 35%, which is what I was talking about. For the next 4 years, it gave negative 2% returns. Then we had an IT boom, which you saw all the small IT stocks booming. Although the IT industry has done the best for India, after that, after 2003, the stocks gave only 9% return. So same thing happened for FMCG. So if you go sector by sector, actually wherever, like 2008, real estate, infrastructure, capital goods, oil exploration, they all compounded between 100 to 40% year on year. Corporate banks, and post that, if you see the next 10 years, the returns have been very, very poor. So this time around, what will give returns? I mean, it is anyone's guess, but we feel utility companies, large public sector units, Then capital goods, infrastructure stocks like Larsen, all those have underperformed. Cement stocks have underperformed in a big way. We feel an economy should hopefully come back at some point of time and do well, because all the macro factors which are there, they are suitable for those stocks to do well. Metals, all those stocks have just done nothing. So we feel that should do well in the coming next few years. Yeah, next slide, Abhijit. Yeah, so this is what I was talking about, the government reforms, the cost competitiveness. China's cost, advantages have narrowed down, and of course, India has a lot of leadership. Individually, people are great, and companies also do very well. So we feel all the things put together, and lot of huge inflows from abroad, and everyone wants to kind of reduce their dependence on China. So we are seeing that. Lot of, say for example, in cell phone manufacturing also, lot of capacity has been set up. Auto ancillaries, chemicals, all those sectors, we are seeing lot of new capacity being set up, and lot of export opportunities coming by, because everyone wants to reduce their overweight on depending on one jurisdiction. So there is a chance, or there is a momentum that can come, and hopefully we should take advantage this time. Yeah, next slide. Yeah, this is a slide which shows how our population is kind of young, and it's it's still growing, and it's kind of, the working population is increasing. So we should hopefully benefit from that our population being young, and we should hopefully do well in the coming years. Yeah, next slide, Abhishek. So this is a very interesting slide. It shows how every 10 years companies who have done well have changed. And for example, oil companies in the 80s, which are no longer there in today. All the companies are dominated by the tech companies. So you have a company like Tesla, which has more market cap than JP Morgan or Exxon. Or we can look at the right, if you see how Amazon stock has beaten the Nifty in a huge margin. So everything gets every boom, you see things getting overvalued, and then you have a huge sell off and things becoming undervalued. So this slide kind of captures it quite well. So from if you see in the 80s, the oil companies dominated the index, whereas now in the 20s it's all tech companies which are dominating. So it's a very interesting chart actually. Next slide. So this I was this shows basically this segment of the presentation will run you through what are the different avenues of investing which people are we are not advocating anyone. I'm just running through what is being done right now. There are a lot of structured products which are available, because there is a the taxation is on capital gains on the interest earned. So normally it's at a lower rate than the the maximum marginal rate. So these structured products have kind of become quite popular. They are known as market linked debentures. They tend to give you a fixed coupon, and are normally basically they run between 1 to 3 years. So the risk in this is that it depends on certain factors happening, or a single issuer, and so this they are quite popular these days. Next slide, Abhishek. This has actually caught the biggest fancy recently, and of course there are two routes to do it. One, you remit the money directly abroad, and you can invest, then buy stock by stock, or do the products which are available are huge, because once you remit money abroad, the basket of investing or is way bigger than here. But those who don't want to remit or don't want to do something very big, you can do it through funds. Almost all mutual funds have a large basket of funds which feed into other funds. So we have also done some funds which feed into certain trends, also are available. So there is a huge basket to remit funds from here also, or you can do it by remitting by just investing in local funds which remit the money. So they get all the SEBI approval, they do all the accounting. And the other option, of course, is you remit money straight out and you have a wealth manager outside. So depending on your requirement, your portfolio size, and whether you are, if whether you are, it suits you, because it needs a lot of working around the accounting, etc. So that way, even LRS, of course, remitting money abroad has an advantage that at some point you can have money outside. If something happens here, you can be outside and use the money. So it is it should be looked into for people who have large portfolios, because it just de-risks yourself. Only in India we have investors who almost keep all their money invested in one jurisdiction, which is our home country bias. So more and more people have, kind of become aware of this option which is available, and that of course reduces your risk in a big way. And returns have been reasonably good in the last few years. But yeah, one should look at it quite closely if one has not done it. There are two ways: either you do it through funds here, or you remit outside. And remitting outside, of course, people buy properties or have aspiration to buy properties outside, etc. So all those can be done once you collect a certain amount of money outside. So this is a very, very popular avenue right now, because both, of course, US tech dominated the returns in the last 2 3 years, and second, people have realized that one should diversify. And it's become very popular also, to have, a basket of portfolio outside also. So and recently, of course, now we have stopped traveling, etc. There's everyone had a child or a family member residing abroad, so people have become quite well versed with this segment of investing. Yeah, next. So these are broadly different strategies of investing, or different products which are available. So I covered structured notes, the equity linked debentures also I covered. Then you have structured products I did cover. Feeder strategies I covered. Then REITs and InvITs is something recently which has come. These are debt alternatives. They basically make available real estate portfolios, rental yields to investors in a mutual fund format. And this is available in a dematerialized, it's available in single unit also. So it's kind of democratized the investing in real estate, where you can buy and sell even a single unit. So recently, of course, Mindspace also came out with an issue now. So this segment is picking up because people have had a reasonably good experience, and yields in this can be around 6 7% with the inflation pickup also, because the rental yields have a inbuilt, every they increase every few years. So there is scope for capital appreciation also in that. Then you have the InvITs, which are linked to infrastructure projects. So we have the InGrid InvIT, which is available, which basically gives you interest on the rental yield of the power lines which Power Grid pays the Sterlite. So over there you get every quarter you get a dividend and interest payment both mixed together, and the yields are quite fair, reasonably high. So because interest rates have gone down sharply in debt products, people are now looking at investing in different baskets in debt also. So this is basically to diversify what one has, to make sure that the returns can be kept higher. So these products, REITs, InvITs, etc., something between equity and debt. Neither they are totally like debt where your returns are guaranteed, and neither they are very volatile like equities. So they are something in between, and easy to invest and easy to divest. They can be bought in small amounts and very, very liquid. Private equity, of course, is the aspiration bucket which I spoke about. It's extremely illiquid, and one has to take a very long term view, but can be very rewarding at times, because the next big ideas come out of private equity. Or so for example, if one were to have invested in pharma companies, some company were to discover some drugs, etc., so those are typically done through private equity. Of course, it is not meant for all. It can be risky because they are illiquid. Once you invest, you have to wait for the tenure of the fund to get over, or the company to divest. So it is not for everyone, but the returns are commensurate with the risk that you take. But this aspect is also coming into India. As people make more and more money out of these investments, then people will kind of invest in these, because unless you see exits happening, unless you see liquidity in the secondary market for unlisted shares, people may not be very it may not be easy to convince people to invest in these. Gold, of course, I spoke about. Every portfolio should keep some amount for safety and stability. Returns wise, see, it's like insurance. Investing in gold is like insurance. If currencies have a problem due to overprinting or too much of excess printing of money, gold should be kept, between 5-7% of a portfolio. A, it is extremely liquid, and second, it is a store of wealth. But in India, of course, gold, there is a fixed income gives you interest also. So people are always trying to compare that with fixed income. So one should not do that. Yeah. So next slide, Abhishek. Yeah, basically these are the advantages and disadvantages of why we should invest in different products, and what are the pros and cons. It essentially, one should diversify. Broadly, what I would summarize, one should diversify our holdings. One should not be over invested in a single asset. One should always keep portfolios liquid, so in case you need money, because liquidity has always that potential. If tomorrow you get a situation like March where everything collapses, you are able to invest. So if one were to buy everything into illiquid assets, you will not be able to change the investments when you really need to. So those kind of things one should keep in mind when making a portfolio. Next slide. Yeah, so these I've spoken about. Yeah, so we can, I think, Abhishek, next slide. Yeah, so I've covered all these. Yeah. Yeah, and last one is venture debt. Of course, extremely risky. And this funds basically the new ventures which are coming up, the technology ventures, because private equity firms fund these, but the companies realize that taking everything through equity is extremely expensive. So they have started borrowing at a high cost, and it's called venture debt. So typically it funds ventures which have been funded by private equity players. So they give, along with coupon, they give some shares which have, recently we have seen the IT shares kind of going up. So these typically, the option value in the stocks is quite high. So people mix it with debt and buy some equity of companies like, here in India, I can say companies like say Swiggy, etc. They have raised debt, so they get large amount of funding through private equity. So that is equity funding. So on the back of that, they tend to issue debt. So here again, it is kind of getting institutionalized. It's very new in India, not for everyone, but it's coming in. And the last one, Prashant Bhai requested me to speak about was art, investing in art. So I am not an expert on that, but my personal belief is that one should invest in art for the next generation. It's like real estate. If you buy and keep, it will help you maybe in the next generation, and it's very, very subjective. So one should buy it for consumption rather than for investment, is my view. It may be wrong, but one cannot definitely exit it when you want to. So one should, tend to buy it for, say, the next generation to, make your living rooms better looking, etc., and buy it with the view that you will keep it rather than trying to use as an investment, because it's extremely subjective and extremely illiquid. So unless a few, masters, the best paintings tend to get values, and we tend to read them in newspaper about auction prices. So we feel that it's a great investment, etc., but tends to get very liquid, and the entry exit costs are very, very high. So one is not able to encash. So it's like when you see, like when one actor like say Amitabh Bachchan does very well in Bollywood, but there are so many thousand and thousand people who come and try to make a mark but are not heard of. It's paintings or something like that. So it's kind of very glamorous but difficult as an investment avenue. So that's what I think I've tried and covered everything. And we'll open it up to questions, and I'll try my best to answer all of them. And like Hina said, whatever, if it remains unanswered, we have our email IDs and we'll try and answer all the questions. Once again, thank you very much. It was really overwhelming. I hope I've covered most of the topics.
Yeah, thank you, Anand Bhai. Excellent talk, and we get back with a lot of learning. In fact, a lot of terms which you mentioned, like how the stock market throws up new heroes every time in terms of newer scripts or newer sectors. Also, the fact that after every crisis, the stock market goes up. So we can look forward very positively to the next 2 or 3 coming years. There is a deluge of questions, and I'm sure we'll exceed our stipulated time, but I hope you're okay with that.
Yeah, time is not a please. Yeah, my pleasure. I hope everyone found it useful, and I hope everyone it made sense to
I'm
everyone.
sure they
Because
did
it's
with the kind of
difficult to
question.
cover.
I'm sorry, please continue.
It's difficult to cover it because everyone is at different levels, and a lot of people or most people may be knowing more than what I'm saying, or have different experiences. So I've tried and just touched upon different things.
Yeah, so actually, looking at all the questions that are coming, I'm sure people have heard very attentively, and they really want to ask, want clarity on a lot of things. So let me take the
Please.
first question from Suresh Bhai Parekh. He wanted to know your view on investment in foreign equities in the current scenario.
Yeah, so like I covered in the chat in the presentation, it's become very, very popular because last 2 3 year returns have been very, very high. It's a very good thought, one should invest, but only problem is over there also the S&P index has been dominated, has also become tech heavy, so much so that it's almost 50 to 60% weightage has gone towards tech. So the same problem like here, that it's become very, very it's the absolute herd mentality trade, that everyone is investing only in the same 5 7 stocks there, so their valuations have gone through the roof. So right now the belief is that because of COVID, companies like see, I'm naming companies, but I'm not. I don't want to. It's not a specific advice on that. But Amazon, Apple, Facebook, all those only are going to do well. Rest of the companies are not going to do well. So the market valuations have become very, very steep on one side. So one should just look at what you are investing abroad also. So my personal belief is you invest abroad in things which you don't get. Just for an example, silver ETF, you don't get to buy in India. You are able to invest there. So something which diversifies your portfolio and it's not overlaid with the same things. So one should invest from a view that, yeah, I want to diversify my money into different geographies and in different products, and do it from that perspective. So don't do it just with a very short term view, because those stocks have really rallied and everyone is globally also. I was just going through, somebody asked me they want a value portfolio in the US from here. There is only one fund which is doing that. Rest everybody is tech heavy right now.
And what is your advice? Investment in rupee terms or investment in dollar terms?
No, you mix it. You do it mix. So if you want to do it in dollar terms, like if you say, for example, you have a need going to come, say you have some family members who are going to settle abroad. You have children who are studying there, may end up staying there forever, or you may be thinking of buying a house in, say, a different location. Then you should invest and remit money abroad also, so that you have a security. If say something some goes wrong here, you are able to, if you feel that way, one should diversify. It is Indians, all of us including myself, we are overly invested in our home country because that's the easiest thing to do. So
We have a question from Nishant Parekh, and he wanted to know how easy it is to invest in international markets, or what is the procedure to get into international markets.
no, it is fairly easy because Reserve Bank has really made it simple now. It's extremely simple. We, in fact, we do it. We've done it for so many families, and it's quite, it's reasonably easy. Only the thing one has to be careful is that you have a backup in terms of your accounting, etc. That you are able to file the right returns, because it does require some amount of work from your side. That every year your disclosures have gone up. You should be able to file the returns here and make sure that they are looked after, because you should not miss any tax compliance on it. Otherwise, it's reasonably easy now to invest abroad. And you get, because over there you have unbelievable amount of diversification which one can do in a portfolio.
Any particular countries you recommend, Anand Bhai, where we should be putting our funds?
No, see, do it geographically. US is a very large market. Then, of course, Europe has not done well. China is doing well. So they, of course, they are again technology wise, etc. A lot of things have come up there. Japan is a good value market, so it should diversify globally. I think one should, like I said in what I was talking, diversify, because what has done well and what will do well are two different things. So one should invest for the future. So you should do a mix of investing in
For
geographies also.
for smaller investors who are just about getting started to investing in international markets, would you recommend taking a stock directly or going through any of the funds?
No, go through funds. In fact, we have in locally available also global asset allocation funds. So you can just write a single check and have the money invested across the globe. And the fund manager there, there's a BlackRock fund, which is he has the ability to choose what asset class. He has no restriction on debt, equity, or geography. So if you have to invest in a single fund, and it's very democratic, you can even invest 10,000 rupees, 5,000 rupees, 500 rupees. There's no minimum. So and there's no holding period. So those kind of things are also available today. So investing that way has become very, very easy now.
Okay.
So for, and it doesn't require any it's treated like an Indian debt product, so you don't need to have a separate disclosure, etc., in your paperwork or filing. So it's quite easy now.
I guess that makes life easier, especially when you
Yeah,
have to invest
yeah,
outside.
yeah.
Lesser
And it
procedural
is totally
hassles.
liquid. You can get your money back in 5 days actually.
We have a question from Neshad Ashar. He wants to know what would be the impact of US election, either way, on the Indian market.
Yeah,
Or
that's
is it
the
advisable
yeah,
to wait for the election to be over before you
yeah.
start a fresh allocation of funds?
Yeah, super question. I wish everybody is asking that question. I mean, it's a tough one because my personal belief is that Biden having announced very high tax rates may dissuade a lot of people to vote for him. But generally, everybody you ask tends to, and the even the poll results are showing that he's ahead in terms of. But it's a tough one to answer. It's anybody's guess, and we have seen in the past that all the polls tend to go wrong in this because one, they are done on a narrow number of people, and secondly, most people maybe a lot of people sit on the fence and they are so closely contested that 5-10% of people changing their minds at the last minute would kind of have different results. But definitely it's an event risk, and markets where they are currently, one should wait for the results to come and then invest, because markets are not cheap and it could lead to a fall whichever way the outcome comes. And it may be not long fall, but it does, like last time also when Trump came, the markets had crashed. So one should definitely wait for that, I feel. But it's a good question, tough to answer. I don't think it was the right answer, but it's very, very tough to
I
answer
think
this.
case in point, in the 2016 election, everybody expected Hillary to win,
Yeah,
especially the non-American people.
yeah.
And it was a surprise that Trump came in and stayed for the whole of 4 years.
Yeah, and the markets have done well. Everyone thought if we came, like when first reaction, they were down 10%, the markets, when they heard he has come. And then the markets have done extremely well because they cut tax rates, they reduced the remittance tax into the country, the corporate tax rates were cut, and they just kept on announcing package after package for and their economy, of course, tech companies did really well. So, so it is difficult to predict.
We have a question from Ajay Jasrani. He wants to know, in any business like manufacturing or trading in goods, we are generally more in control and take our decisions, which can result in the growth of business. But how much are investors in control of their business uh, how much
Yeah.
are the investors in control of the business, if you call it as growth? As I understand, it's a highly dependent and mostly external factors are beyond investors' control. I think he means the stock market. How would
Yeah,
you?
yeah, I understood the question. Very apt question. So one is not in control in the short run, but in the long run. For example, if you look at the short run, look at the volatility in the short run. So, for example, in March, the index was near 8,000. Today, it's near 12,000. And I can assure you, nobody predicted that. No one knew. But if you take a long-term view, like I said, when the index has started in the 80s at 100, and today it's near 40,000. So it becomes predictable as time elapses. So one has to ensure that you are invested in with a longer term view and a diverse manner. Because if you invested in, say, particular stocks only, say for example you were invested only in infrastructure, capital goods, utilities, then you didn't make any money in the last few years. But if you have a diversified portfolio, then if you are able to hold it for longer periods of time and not get dissuaded by recent events, then one tends to, the predictability goes up very, very high. So if you take a 3-year, 5-year, 10-year view, then it is very predictable. It always gives you more return than debt in the longer run, but in the shorter run it is very difficult to hold. And it's very easy to say, long term you'll always make money, but in practice to apply it is very tough, because when the volatility kind of unnerves you, and the unpredictable nature in the short run makes sure that you make mistakes. So like just from a very recent perspective, everybody is going on investing in the same sectors like tech, IT, and so everyone makes the same mistake. It's like everyone wants to invest in what is going up. Nobody wants to buy and hold. So predictability, to answer the question, is high on the in the long run, very low or poor in the very short run, impossible in the short run.
Okay, we have almost chronologically the next question by Jayesh Bhai Bhatia, that market valuations appear to be very high currently and in deviation to the economic indicators and company fundamentals. Is it still a right time to invest in the markets, or have the markets peaked out? And should retail investors wait for some time before putting in their money?
No, as I said, the valuations are very high on very narrow sectors and stocks. So it is very cheap on one side and very expensive on the other side. So gradually that has started changing. So for example, see, if you see till March, only non-bank finance companies and private sector banks were doing very well. Now in the fall, if you see the private sector banks, only one bank, HDFC Bank, has recovered some amount. Rest, if you see, other banks have kind of, they are down 20 to 30%. Say Kotak Bank is down from the peak, ICICI Bank is down, Axis Bank is down. So the correction has, or NBFCs, for example, Bajaj Finance and all, are down 30%. So different segments do well in different times. So it's not necessary that the whole market is expensive. So consumer stocks also, like I said, were very expensive in March. Now they have started falling. Although the index has gone up 40-50%, they are down 15 to 20% from their top. So different parts of the market do well in different times. So one should invest, I feel, in small. There is a lot of value in the basic economy stocks, and inflation will come back because interest rates are so low that finally something has to give way and something has to go up. So commodity prices, metal, cement, all those should do well, because they have done nothing for so many years, because the economic pickup has not happened. First you had a GST problem, then you had demonetization, now you had this COVID thing. So time and again the economy actually, the pickup in economy has not happened as was expected by everyone, but it has to happen at some point of time. So that's what. So invest in diversified funds which have more value orientation, is what I would think.
Next question by Ramesh Bhai Ved, and he would like to know that it is now the practice not to hold for a very long term. The old ideology was to hold the investments for a long term, but presently, people ask to churn regularly or to take help of advisors. So, when is it advisable to change the strategy?
No, this question is right, because the run up and the fall have become very fast. So the it is confusing, because that old theme is not working. So if you see very recent last 6 months, first you did auto sector did well, then you had pharma which was doing very well. Now suddenly IT did very well, and it does so well that stocks like large cap stocks like Infosys and all have doubled from the lows of March. So it is tough to kind of say the question is very right. And now recently the bank stocks have started coming back to life, so the rotation is very fast and high. So what I would suggest, to better to put in funds, because the underlying switches with the fund makes is not taxable or not required to be decided by the investor. So better to put in diversified funds. And again, there is a bias to only invest in funds which are doing well. So so we have to make sure that you go through what the fund is investing in also. So they also tend to buy at times, because everybody is chasing return. It's like, if you give analogy in simple cricketing terms, you are investing for a test match, but it's like 2020. Every day you tend to see returns. So then you make mistakes. And because the funds are also open ended, people tend to put money only in what is doing well. So there also there is a mentality to chase returns. and people don't weigh the risk that you are taking to get the returns. So we should always try and see what risk we are buying to get returns, and not just keep looking at returns. That returns, we should not chase returns, because how the returns come, it's like, in simple terms, if somebody is giving you 18% return on fixed income, definitely you should worry about the capital. So as inflation rates go down, your return expectation also has kind of, we have to tone them down. Previously, our funds had compounded at 20%, but now since inflation is so low, even if you make 10%, it should be a good rate of return. So our return expectation have to kind of that way get aligned to the new reality, that interest rates are low, and your risk adjusted return also will come down because of that.
So with that thought in mind, Anandbhai,
So
how
that was.
often, we have a question from Ashish Bhakta on the same lines. How often should one
Yeah.
be looking at their portfolio to introspect the investment to assess the growth?
So what we do typically for clients, we do every 3 months, we do a quick review, whether, if there is, normally we don't make any changes, but we do review from time to time so that people get an assurance that it's going on well, and things are on track. So we tend to look at every 3 months, and do look at it. And recently, because everybody has more time on hand, they are looking at it every day. But that tends to make, you tend to make mistake in doing that, because you tend to take decisions regularly, and look at short term situation more often, and gets you worried when you keep watching it every day. It's like, if you buy stocks, for example, you are seeing the CNBC ticker all the time. So I had a very funny incident. I had gone for a meeting, and the client was continuously looking at on the floor. So I was wondering what has happened. Is there something down? Then when I looked down, I could see a CNBC screen down. So it's kind of addicting. So then you tend to get worried, because you are not even able to focus on a meeting, because you are watching the ticker all the time. So it's better to do it far and in between, and leave it to have some advisor who also looks into it at the same time.
Yes, it's best left to the experts. Otherwise, you'll have to leave everything and keep watching the CNBC the
Doing
whole
that,
time.
yeah. Yeah.
And which sector do you think will perform the best in the next 5 years?
5 years is a long time, but in recent times, from undervaluation, I feel the basic economy stocks, which should do well, because the economy has to pick up. Otherwise, there will be a lot of stress or problem. So I feel the economy linked sectors should do well. So cement, steel, infrastructure, capital goods, all those should, utilities. So those sectors should do well, because see, if you see recent reports also, our fuel consumption, electricity consumption, all that has gone back to pre-COVID levels. So those sectors are cheap, so that sector should hopefully pick up. But difficult to say 5 years, because like one of the questions, that the movements are very fast. Suddenly you see 40-50% return happens in 3 months. Like, for example, auto sector has doubled from March levels, which was unthought of. So one of the slides was showing M&M has doubled from the low from March. So it is tough to then generate returns continuously. So cycles have shortened for sure.
Say of the auto sector, now there's the government drive to move on to the electrical vehicles. And probably by 2030, they would have moved a lot of two-wheelers onto the electrical segment. A lot of four-wheeler manufacturers are also getting onto the electrical segment. So is there any particular company on which you would like to lay your bets?
It is tough, because India, we have not, I don't see so much movement towards electric vehicles. As of now, we have not. But yeah, of course, Tata Motors has a lot of electrical vehicles. M&M is trying to introduce, but we have to see the pick up in usage, because I don't think we are not anywhere close to what you see, say, in Hong Kong, or China, or US, or Europe for that matter. So our conversion will take time, because the infrastructure has to be built. Hopefully, at some point, with the governments enforcing it, it should come through. But
This may
it
not be
will
the
take
right
some time.
time to place your bets on any of the companies yet. I mean, people still have to
No,
stabilize.
yeah, but it can happen very rapidly. The changes happen very fast, because it is very, very cheap to use electric cars, and they are really beautiful if you drive them. Like, I drove one of the Tata vehicles. It's really beautiful. You can't make out that you're sitting in a car. It's kind of, it takes some time to adjust. It makes no sound, and goes quite fast. Yeah,
The infrastructure still has to develop for the
develop. Yeah,
vehicles to start
yeah,
coming in.
yeah.
So while you were talking of the sectors which will do well, I noticed that you didn't mention the pharma sector,
No,
which is
pharma
what.
will do well. No, no, sorry. I said that pharma has done well. That's why I said going ahead. Pharma is well priced, so it is building in lot of positives. So not to pharma will do well because it's a evergreen sector that way, and it should do well. But it is not cheap. It is well priced. Like IT, pharma has recovered quite a bit from the lows. So except for some large ones like say Sun Pharma and all, which have not moved up, lot of the other stocks have gone up quite sharply in that sector.
A question from Vinay by Vimani, who wants to know that do we expect a higher rally in the pharma sector in the coming future with the vaccines coming out and all?
Yeah, it is a tough one. It is possible. Like today, Dr. Reddy's has announced that they are tying up for that vaccine. So it is possible if somebody does get a cure and a vaccine comes, it can go up. But they are well priced. They are pricing in a lot of the upside, is what I feel. It may be wrong, but I feel they have gone up quite sharply. So the returns will be moderated.
What about gold? Is that we have a question from Nilesh Ved, who wants to know if gold is still an attractive option for investing at these levels. How do you foresee the gold prices in the near future?
See, best people to buy to check when gold is doing well is the retail shops in Chennai. So there, if you ask them, people are selling gold and not buying. So the largest amount of buying has happened by financial investors in the last 6 months. So both central banks stopped buying, and some central banks have sold, and retail investors were selling gold. So the prices have started stabilizing. So it's in a step function. After giving very large returns, the returns tend to consolidate. So, like gold depends on rupee depreciation, which has stopped for the time being because our macros have kind of improved and lot of dollars are coming into the country. And second is that everyone bought into, so people are kind of retail demand has crashed with such high prices. So and there is so by and large the returns will be muted. But like I said, that you buy it as an insurance. If currencies have a problem due to overprinting, then you should have some amount in gold.
So, would that translate into saying that gold is presently only a temporary place where people have parked their money? It will soon move out to other sectors?
No, it is not right to say that, because see, these three, four asset classes I've seen: real estate, gold, fixed income, equity, they are all there to stay. It's just that once they become overbought, they tend to do nothing, consolidate or come off, and then they wait for the next cycle. So it is never, that you can take a view for sure that it's not going to move up from here. So this thing, I would think it's not, you can't say that now gold will not do well and one should exit. So one should keep some amount in gold, say like I said, 4 5%. And someone asked on the screen whether silver silver, globally ETFs are available, locally they are not. And yeah, definitely it may be because silver in simple parlance is available in kilos, whereas gold, you get in grams. So
Yep.
ability to appreciate may be more, because both are being silver is being used industrially also. So I would think silver can give you returns, because if the economy picks up also, it does well. But difficult to store, because you are in India, we don't have any financial method of buying it. You have to buy physically, or you buy gold ETFs, silver ETFs, which are available internationally, for which, like you said, you have to remit money, and it's a cumbersome process.
And gold, physical gold or sovereign gold bonds?
Tough one again. See, some amount of physical gold is always good, for especially Panje Bhatiyalok mein to we keep ornaments, etc. So that part is taken care of. But otherwise, sovereign gold is good because it gives you interest also, and you have, it's easy to buy. And only downside is it is illiquid. You have to hold it at least for 5 years. Otherwise, you can buy ETFs also.
We have a question from Dhruti, who wants to know aviation sector has been battered with COVID in the recent times.
Yeah.
And all the airlines are doing pathetically. So, do you see a recovery in that sector? And if at all you had to invest in the aviation industry, which is the stock you would recommend?
No, so there are many sectors, like aviation is down, hotels are down. They are those COVID affected sectors, hotels, theaters, all these are down. retail physical retail stores, etc., would be down, because everyone is sticking to Netflix or to buying things online, watching movies online. Now it one has to see whether how fast this COVID kind of, because it's from aviation sector, see how fast all of us get we start going back to travel, how many airlines survive, how many people go back. So it's a tough one, but if the valuations have not come off very sharply, but one normally whenever you buy a stock, you should buy one which is not over leveraged and not indebted, so we'll be able to hold on. Someone has to survive, some will everyone will some industry, because whenever such huge crises happen, the leader becomes bigger because the others fall off. Like you saw in telecom many years back, you had so many players, now we are down last to three. So it aviation also consolidation will happen, and we'll have to see. So as of now, I mean, visibly one can look at, see, Indigo is has very less debt, so that's the stock one can evaluate. But having said that, one has to see how this whole thing unfolds. Will people travel back, or will be content just doing Zoom meetings? Discretionary travel will just stop, or or people will just say, that whatever happens, let's go out. Like we are seeing, hotels are suddenly all full, so one never thought that you would go, and but everyone is so tired that they want to go and go for a vacation in and around their cities, etc. So one has to see. It's a tough call to
By and large, I
answer.
think the aviation sector and the telecom sector, as you mentioned, I guess there is a different principle of investing in these two sectors.
Yeah. Yes.
That
No,
is,
in all sectors actually. When high P, when it becomes very high P, then you take a risk. But you should be aware it's a risk. It will recover for sure at some, because given time it has to recover. But how much time one should be able to hold on, not to put too much so that you get very worried about it. That's the way I would answer this.
we have a question from Ramesh Vaid, who wants to know what is the desirable asset allocation in equity, gold, real estate, debt, etc.
Asset allocation, like I said, see, depending on, in debt you put as much as you need for fixed income and and for your day to day living expenses. In a generic way to answer, you should, whatever you put in equity, you should be able to take 10-15% fluctuation without getting worried about it, and have a 3 to 5 year view. Rest of the money, if you get worried when markets fall, then you should invest majority in debt, or 60%, 50 to 60% in debt is the general generic norm, so that the portfolios are in that sense kind of shock proof. And finally, it all depends on each situation, but you should invest something which you are, which is surplus and not going to affect your lifestyle, that if it goes down, and it will not affect you mentally also, that you will get very worried about it and have sleepless night over something.
And you mentioned about the Atmanirbhar scheme during your presentation.
Yeah.
So, with the Atmanirbhar scheme in mind,
Yeah.
would it be wise to invest more on the manufacturing sector or the service sector?
Yeah, service has, like I said, gone up. So manufacturing, there is a good chance that we do catch up. So I would think one should evaluate manufacturing sector, because there is a good, they are available cheap, and whoever is able to scale up, there is a good case to invest there. So I would think it's a good sector to look at.
We have a question from Neshit Bhai, who wants to know, can you name any mid-tier IT company, if appropriate, which can be, say, Infosys, HCL, or
No,
TCS of tomorrow?
those are extremely, yeah, those are Infosys, HCL, and all have, of course, they've become very big. But all the smaller ones also are trading between 20 and 30 times, Nishad bhai. So the sector has really gone through the roof recently. I don't know whether it's appropriate or no, but see, don't invest by what I'm saying. Only one which looks cheap is Oracle, which is trading at 15 times. But this is not advised to invest or anything, but just from valuation perspective, it is looking cheap, and it has a huge dividend yield also. So that's the only one. It's fairly large. It's not a small company, and it has MNC holding. So in that sense, 74% is held by the promoter. That looks okay. But please don't over invest or anything. I'm not. This is not our official view. It is not something. If it, there is some fluctuation, please don't get worried about it.
No, I think will, of course, use their own discretion while investing.
Yeah.
So, one question we have from Kaushik Sampat is, can we say that the NPA issue, as far as NPFCs are concerned, is almost over, or you think it'll raise its head again in the next few months?
No, again, it's a tough one because now there is a moratorium, so it is difficult to judge. So there are some institutions which are doing a cautious approach, the larger ones, and they are providing for COVID by an approximation method. They are providing wherever people have taken moratorium, they are providing for those. But one has to see whether, like, say for example, State Bank has said that the moratorium loans have reduced very drastically in their portfolio, and the home loans 90% plus are being used by people who are using the home, so unlikely they will give up their houses. So one has to see. We are hopeful that the NPA problem will not become very big, because the corporate NPA cycle has kind of is tapering off, and all the transactions are happening. All the companies, like I mentioned, DHFL today, there are bids, Jet Airways, there are bids. So all those are happening, and there was not huge loans given to that segment subsequently. The retail loans, hopefully, one feels that people will kind of come back, the economy comes back, and people start paying in time. So the
Okay, hope.
larger banks have been beneficiary this time, because all the fixed deposits have moved to larger banks. After there were some FDs which failed, so people have just moved out of worry and concern to larger banks.
At least the situation is not as discouraging as people thought it would be around the
Yeah,
beginning of the year.
yeah, I
We'll
would
take
think
one
so
last
too.
question, Anand Bhai.
Yeah,
We have a question from Umesh Bhai Ved, who wants to know what are the investment options for senior citizens. And in case, if a senior citizen has received some amounts which has to be invested now, what would be the ideal way to invest it?
yeah. So like I said, one should invest in very liquid things, where for especially senior citizens, and not worry about the yields. So fixed deposits of companies are there, manufacturing companies, or say something like an HDFC fixed deposits, etc. At least they have some yields. Then you have, like I said, InvITs are there, but invest and have, of course, fixed deposits for their basic needs, so that they are taken care of. And then you have, I think, debt short-term funds also are there. Mutual fund short-term funds are quite good, and if they are not in very high tax-paying bracket, then you can have a systematic withdrawal plan on the short-term debt funds. So they are also giving a reasonable amount of return, say around 6%, and you can it's completely liquid, and you can keep them in growth option and redeem them as and when you need to. So they are also quite a good option, and they are completely liquid. So the safety is in liquidity, that you need, whenever you need the money, you can get it the next day. So the funds tend to invest in diversified portfolios, so they are good options again. So diversify by and large, and keep some money in a bank FD, so that it is accessible to you at any point for senior citizens.
Thank you, Anand Bhai. That was a very comprehensive talk, comprehensive advice, and I'm sure all the people who have joined today, they're going back richer in the mind and hopefully very soon richer on the pocket as well.
No, no, I should thank you. You all have done an excellent job. It makes me proud that Manja Lok Mare Sathe Hain. Hopefully, once the COVID ends, we meet. Thank you very much. It was really overwhelming.
We look forward to the meeting, Anand Bhai, and I would also
Yeah.
like to take this opportunity to thank Abhishek and Neha for so ably supporting you. And
Yes.
thank you for coming on Drshtikon, Anand Bhai, and sharing your views with all the people present today. I would also like to thank
Thank you.
Ashish Bhai Bhakta for referring yet another Bhatia gem to us. Ashish Bhai Bhakta had been a speaker on this
Yes.
forum earlier. Thank you so much for referring Anand Bhai and giving us this opportunity to host him today on this talk. And meanwhile, all the people who have joined today, thank you for coming in. Thank you for sparing your time to be on this session. Our next session will be on the 1st of November, where we shall be featuring Dr. Rajinder Toprani, who is an oncologist and head and neck surgeon. And he will be talking on cancer and cancer prevention. So please do join in on 1st of November. Meanwhile, if you want to give us any feedback or write to us, please write to us at drshtikon.talks@gmail.com. That is drshtikon.talks, drshtikon.talks@gmail.com. And on behalf of Drshtikon Talks and for the team present today, including Hina Bhimani from Chennai, Tejna Sampat from Calicut, and me, Prashant Borparia. Thank you all so much. We shall look forward to seeing all of you once again on the next session. Thank you, Anand Bhai.
Thank
And
you.
a big thank you to the viewers too.
Everyone stay safe. Bye. Jai Shri Krishna. Yeah.